Welcome to this episode of Corporate Highlight. My name is Jun Yuan, and I'm the founder of the investment blog, the Singaporean Investor.sg, and author of the book, Building Your Retirement Portfolio. I'm deeply honored for the opportunity to collaborate with AlphaInvest to bring you the Corporate Highlight video series. In each episode, we will be spotlighting a Singapore-listed company, aiming to provide retail investors here in Singapore with valuable insights to help them make more informed investment decisions. In today's episode, we are focusing on Centurion Corporation Limited. I'm delighted to have the company's CEO, Mr. Kong Chee Min, as well as the Head of Communications, Mr. David Fay, with us.
Hi everyone. Thank you, Jing Yuan, for the introduction. My name is Chee Min. I'm the CEO of Centurion. Welcome to this webinar. Great to see you all here. I hope that the session will be insightful for all of you in terms of knowing who is Centurion and what is the investment insights that you could take away from this webinar. So I would like to introduce my colleague, David Fay, who is actually the head of comms. He will be taking through the presentation. Okay, David?
Yes. Hello, everyone. Welcome to the AlphaInvest Corporate Highlights webinar today featuring Centurion Corporation Limited. I'm pleased to share with you an introduction to the company and our investment merits. The presentation today will be based on our full year 2025 and second half 2025 financial performance with some updates on the portfolio between December and today. I'll cover off in 5 brief sections, a quick introduction to the company and our business, then a review of our financial performance before we look at market outlook and the business fundamentals. Then we look at a quick ESG update, our focus on the environment and social and governance sustainability, before we talk about how the company plans to grow moving ahead. Going into corporate overview, I'm sure many of you already know that Centurion is a property company, but the kind of properties that we focus on as our business is quite a unique asset class, a unique type of property business. Generally, it's referred to as living sector, and these are long-term rental properties, accommodation properties. There are 2 core pillars to Centurion's business. One is purpose-built worker accommodation. We've been operating this worker accommodation business since 2011, starting in Singapore, then expanding into Malaysia, and 2 years ago, began to have a small presence in Hong Kong, SAR, China. The second core business of Centurion Corporation is purpose-built student accommodation. We entered this business in 2014 and have since then grown the portfolio of student accommodation to today. We have assets in the UK, Australia. We had 2 assets in the US and 2 small assets master lease in Hong Kong, SAR, China. Then in 2024 and into 2025, we began to operate a build-to-rent accommodation in Xiamen, China, exploring that market opportunistically. The interesting thing about both worker accommodation and student accommodation, both of these are very established, resilient asset classes, property asset classes. Very strong market fundamentals in terms of demand, supply, and rental rate growth, and a very strong track record of consistent earnings and cash flow between 2011 till now. I'll share more about the growth in earnings and cash flow in the next slides. And in these 2 areas of business, worker accommodation and student accommodation, which are our core business, Centurion has built and established brands and management platforms that enable us to efficiently operate these assets to good quality and retain customers, attract customers with the strength of the brand and management expertise. And with these platforms, brand and management platforms, we are now able to grow our portfolio of managed assets and owned and managed assets through asset-light strategies. So 2025 was a significant year for Centurion Accommodation. This was a year that we have successfully listed Centurion Accommodation Real Estate Investment Trust, a REIT called CARI, on the main board of Singapore Exchange. We effectively sold 14 of our assets, the most stable and mature assets, into the REIT. And with that, we were able to recycle capital so that we are able to deploy the capital for further growth of our portfolio of assets under management. And also as the property manager and REIT manager of CARI, we now have stable recurring fee income for those management services we provide to the REIT. And with the REIT in place, now it also means that in future, when we develop or acquire and operate assets and they become stable, we're able to again offer them to the REIT, sell it to the REIT, and recycle that capital for continual growth of our asset under management. So with that significant milestone, establishing a REIT and becoming asset light, freeing up cash to further expand, we have also been included in 3 key market indices. In fact, we've been listed on a larger number of indices, but these are the 3 most notable and significant. The S&P Global, the SGX-IH Singapore Next 50 Index, and the MSCI Small Cap Index. In fact, with the SGX-IH Singapore Next 50 Index, we have been reported to be one of the best performing component stocks in the last month. Also in 2025, we've been recognized by Forbes Asia as one of the top 200 best performing small and mid-cap companies in the whole of Asia Pacific. And out of that 200, only 5 are SGX listed, and we are one of those 5. So we're quite honored by that. We've also been recognized by the Edge newspaper in their $1 Billion Club Awards as offering highest return to shareholders over 3 years, as well as higher weighted return on equity over 3 years, and as the overall sector winner in consumer cyclical sector. The Share Investor Association of Singapore, Securities Investor Association of Singapore, has also in their Investors' Choice Awards recognized our CEO, Mr. Kong, as the outstanding CEO of the year. Okay, but back to our business, right? So I mentioned that we have started into this business of living sector specialized accommodation assets since 2011. And you'll note from this chart how we have grown the portfolio of assets and bed capacity over the last 15 years. You will see that we've grown very significantly between 2011 and 2016. And then in 2018, there was a slight dip in the bed capacity, the bed count. That was because one asset, the land lease, expired and we returned the land to the Singapore government. But we built back our portfolio after that. And then in 2022, you'll see another dip. In 2022, in Malaysia, the government implemented new standards for worker dorms, and we had to retrofit, refurbish all our worker dorms in Malaysia to meet the new specifications. So in 2021 December, all our assets were certified under the new specifications issued by Malaysia's Ministry of Manpower called JTKSM. And so there was a reduction in bed capacity. However, in 2022, there was no reduction in revenue or profit because in Malaysia, employers rent by apartment units. So regardless whether the apartment unit has 16 beds or 12 beds, the employers pay the same rent, even though there are fewer beds. So there was no impact on revenue for that year. We continued to build our portfolio, and in 2025, we added almost 9,000 beds, 8,918 beds to the portfolio. And then in 2026, we have a further expected addition in bed capacity of about 4,635 beds. So today, Centurion operates a whole portfolio of 41 properties in 14 cities in 6 countries, totaling just under 79,000 beds. And the assets together that we manage, the assets under management, is valued at 2.7 billion. And as mentioned, we have established brands for Westlite for worker accommodation, Dwell Student Living for student accommodation. And last year in July, we launched a second student accommodation brand called Episode. This is a more premium, higher quality service and maintenance and fit out brand to attract a broader spectrum of students, including those with higher spending power. With the spin-off to Carry, today, our total portfolio can be also looked at in 2 types of portfolio assets. One is on the left, those assets that Centurion Corporation continues to own and operate. And from that, we get the full income of the operating revenue. So we have 24 assets, 53,100 beds, with an AUM of approximately 0.8 billion that we own and operate. And this includes 5 worker dorms in Singapore, 13 worker dorms in Malaysia, as well as some student dorms in Hong Kong and 1 in Australia, one in the UK, and the BTR in China. On the other side, there are the assets now owned by Carry, or some assets owned by private funds that we have started and managed. And these are assets that we manage for the owners of the asset. And for these assets, we derive the fee income for managing the assets for the owners, but also derive the operating income from the percentage of the properties that we continue to own. So for Carry portfolio, there are 5 worker dorms in Singapore, 8 worker dorms in the student dorms in the UK, and 1 student dorm in Australia. And Centurion Corporation continues to hold 42.9% of the units of Carry. So we also earn income from the distribution that Carry issues from their earnings, right? We continue to hold 3 private funds. Worth a note, 2 private funds, 3 assets. In the UK, there is Centurion Student Housing Fund, which Centurion manages the fund, and we own 14% of the units in that fund. In the US, there was Centurion US Student Housing Fund, in which originally they had 6 assets. We started the fund, we managed the fund, and we managed the properties. That fund has now come to term. So the shareholders in that private fund have decided to close the fund, sell the assets, and take their money out. For this fund, we hold 28.7% of the fund, and we manage the assets and the fund. So we have sold off 4 assets already. The last 2 assets you see here, Dwell Towers on State, Dwell the Statesider, we have completed the sale of it in the first quarter of this year, at the end of February, beginning of March. So as of 31st December, we had these assets. As of today, we no longer have these assets. We have sold them. Okay. Now, if you check back to our growth cycle from 2011 till now, we have continued to build the revenue. The compound annual growth rate of our revenue and profit between those years, 2011 till now, is 25% annual growth rate in revenue and 26% annual growth rate in net profit. If you notice, during COVID, 2020 and 2021, the revenue dipped very slightly, but the profit, if you look at the bottom bar chart, didn't fall at all during COVID. Throughout the COVID period, we continued to grow our net profit. And post-COVID, 23, 24, you will see strong revenue growth and profit growth in those years, and that's based on the recovery and the rebound post-COVID in terms of demand and supply. For 2025, we were also able to record strong revenue growth of 17% year-on-year and profit growth of 26% on core business year-on-year. Okay, let's look at the financials. For 2025, the full year of 2025, Centurion Corporation reported revenue growth of 17%, bringing our revenue to 296 million. Net profit was 141.6 million. Now, if you compare year-on-year, net profit was lower by 63% than FY 2024. This was mainly because in FY 2024, we had very strong fair value gain on investment properties. This is not cash or core business gain. It is a valuation of our assets that we do every year to revalue our assets to market. So in 2024, there was very strong fair value gains. In 2025, we had fair value gain, but just not as large as in FY 2024. The revenue growth was higher because of higher revenues in Singapore and Malaysia worker dorms and UK student dorms. And also there was lower tax expense, mainly due to the lower fair value adjustments. We also incurred some stamp duties. I'll detail out the costs in the next slides. Now, excluding the one-time cost adjustments or one-time profit adjustments like fair value gain as well as stamp duties and administrative costs related to the listing of Carry, net profit from core business for FY 2025 was actually 139.2 million, which is 26% increase from the year ago. Breaking down our revenue, the majority of our earnings and our profit comes from worker accommodation. and that is mainly driven by Singapore. So if you look at the top pie charts, worker accommodation accounts for 79% of group revenue in 2025. Student accommodation delivered 20% of group revenue, and other like BTR, ancillary revenue delivered 1% of group revenue. If you break down by country, Singapore is the largest contributor, 72% of group revenue, followed by UK. UK is our second largest market, 14% of group revenue, followed by Malaysia, 7%, Australia, 5%. So in totality, if you look at it, Singapore delivers 72% of group revenue, and the remaining 18%, 28% of group revenue comes from international markets, including UK, Malaysia, and Australia. Deep diving into revenue, I'll skip the two half and go straight into the full year, okay? For full year of 2025, revenue was reported at 296 million, 17% growth year on year. And this was mainly due to new assets and new bed capacity that we included into the group. So Westlite Ubi, a new worker dorm in Singapore, became operational in December of 2024. By March, it had reached close to full occupancy, end of March. And so for the bulk of the year, 9 months of the year, it was contributing quite strongly to the group revenue. Also, Westlite Mandai, before September, the sale of Westlite Mandai to Carry, Westlite Mandai was 45% owned by Centurion, 55% owned by a third-party joint venture partner. So we were only able to book 45% of the earnings and profit from Westlite Mandai. But when we sold this asset to the REIT, the third-party joint venture partner also sold their proportion of the asset to the REIT. So for the fourth quarter of the year, we were able to derive the full revenue from Mandai consolidated to the group. So revenue numbers increased mainly because of these two drivers, as well as across all our 4 core markets, Singapore, Malaysia, UK, Australia, we saw healthy rental growth and very strong occupancies, close to full occupancies in Singapore and UK. Net profit, I mentioned, was 63% lower year on year, although still a very healthy 141 million, 41.6 million for the full year. And this was mainly due to, we recorded a fair value gain of 32.9 million for 2025, but compared to 2024, where we reported 296 million in fair value gain, it just was smaller in comparison. Okay, there were also costs in connection to Carry. We spent about 51 million in costs connected to the listing of Carry. This included 32 million in stamp duties we paid by Carry to acquire Westlite Mandai and Westlite Juniper. And this item was recorded as fair value loss on investment properties. Then there was 18.8 million in admin and other costs related to the listing of Carry. Apart from that, admin expenses, excluding IPO-related expenses, also increased 26% due to things like lease registration levies and also higher manpower, higher professional fees, and advertising and marketing expenses as our portfolio grew. But again, excluding all these fair value adjustments and one-offs and reclassification of exchange differences, and the listing cost for Carry, net profit to equity holders increased 9%, mainly due to higher revenue across our markets, higher interest rate and lower tax, mitigated by some higher admin expenses. So overall, the group has performed quite well. 17% revenue growth, 26% net profit growth, excluding fair value adjustments, and net profit to equity holders from core business at 9% growth. Breaking down worker accommodation and student accommodation, you will find that worker accommodation generally gives us stronger margins. Revenue for worker accommodation in 2025, again, let me skip the second half and go straight to the full year, right? For the full year of 2025, revenue for worker accommodation was 233 million, and that was a 20% growth year on year for worker accommodation business, Singapore and Malaysia. Segment profit was 151 million, and segment margin was 65%. There was a slight dip in segment margin profit margin for this worker accommodation portfolio. That 2% was mainly due to valuation of property and property taxes related to that. So the government in Singapore revalued the properties that we held, and the property tax then increased, and as a one-time adjustment, it led to a slight dip in our profit margin. For student accommodation, revenue grew 3% for the year, and profit grew 18% on the year. In fact, profit margin for student accommodation increased by 7 percentage points for the year. After the spin-off to the REIT, the 14 assets sold to the REIT, our cash and bank balances are very healthy. It has increased by 320% almost to 373 million. Current assets also grew to 407 million correspondingly. And in total, you look at our total assets, it's grown 50% to 3.3 billion. All right. Liabilities rose also correspondingly. But if you look at net assets at the end, it's 2.17 billion, 76% growth versus 1.23 billion the year ago. Net gearing ratio, as a consequence, has also been brought down from 29% to 12%. So today, Centurion has very healthy net gearing ratio at 12%. Interest coverage is very strong at 5.2 times. And we have a long-term debt maturity profile over 5 years. There are no immediate high debts that need to be paid. So we are in a very good position with lots of headroom, both cash and debt, to further grow our portfolio. So in terms of key ratios, earnings per share, EPS, for the year was 13.65 cents. If you exclude the fair value adjustments, earnings per share from core business operations, the earnings from our properties, is 12.91 cents, which is an increase of correspondingly about 9% from 11.81 cents a year ago. Net asset value per share has gone up to 1.47 Singapore dollars, $1.47 Singapore, versus $1.37 the year ago. Now, share price, as at the end of 31st December 2025, was $1.34. I think today it's trading a bit higher, $1.40 plus. Now, the board has therefore decided to recommend it to reward shareholders with a final dividend of 2 cents. We had issued a dividend, paid out a dividend of 2 cents at the interim, the half year of 2025. And the final dividend, the board is recommending 2 cents more, which will bring the total dividend for the year to 4 cents. Additionally, the board has recommended a special dividend in specie. The company currently holds 42.8% of the units in carry. We will distribute some of those units to shareholders as a reward for, to our shareholders. And the recommended special dividend in specie, distribution in specie of carried units, will be based on 1 carried unit for every 10 Centurion Corporation ordinary shares held. So this is subject to shareholders' approval at our AGM coming soon. We would also like to share with the investment community some breakdown of how our revenues will now derive and grow after the REIT spin-off. So before the REIT spin-off, we own all the assets, and we generated and retained all the operating revenue and profit. So now that we have sold 14 of our assets, comprising the larger chunk of our portfolio into carry, where will the earnings come from? So now we own less assets, we are more asset-light, we have more cash and lower debt. Where will our revenue come from? Let's look at it from 3 buckets. The first bucket, or the first pillar of our income, is operating income, where, as I mentioned earlier, we continue to own a number of assets, including worker accommodation in Singapore, Malaysia, and some student dorms in Australia, UK, and Hong Kong. And we will continue to operate these owned assets and derive the revenue from there. So as an example, for the 4th quarter of 2025, after the REIT spin-off on 25th of September until 31st December, the revenue for assets that we continue to own and operate was 30.5 million. And the profit from this owned and operated assets was approximately 11.9 million. If you look at now, we manage the assets of carry, and I mentioned we also manage the assets of the private funds. This revenue is fee income. We get paid a fee for managing these assets for the owners of the assets. The revenue for that same period, 25th September to 31st December, was 6.5 million, and the profit was 3.2 million on the fees. Now, for this fee income, you'll notice that the margin on the fees is higher at almost 50% of the fees paid. The third source of revenue will be investment income, where we continue to hold 42.9% of the unit of the REITs. It was 42.8% at the point of the REIT listing, and because we received the REIT manager fees in units, it has now become 42.9%. So revenue that we expect to receive from the distributions from the REIT, the DPU from the REIT, will come to approximately 12.8 million net to Centurion. Of course, for DPUs paid to a company, there are some taxes, so that will marginally reduce that amount. But on both sides, looking at the owned and operated assets, Centurion Corporation, the cash and bank balance is 294.5 million and borrowings of 333 million. Carried themselves, the REIT has cash and bank balances of 78.6 million against borrowings of 372.5 million. So very healthy interest coverage ratio. Okay, so that gives you a good sense of our financials, I hope. I'll now go on to a quick overview of the market outlook and business performance in the year ahead. Okay, to understand worker accommodation, there are two main business drivers. What makes an employer willing to put their worker in a good quality dorm and pay the healthy rental rates there? There are two drivers. One is where the government requires employers to take good care of the workers that they bring into the country. And two is internationally, when labor organizations and ethical associations and employers or main contractors require the employers in Singapore to take good care of their workers. So, for example, when a petrol major like Esso or Shell engages a main contractor to do the refinery work, they require that main contractor to follow their international ethical standards for taking care of workers. Or when a manufacturer like Dyson or Hitachi appoints a factory to produce their hair dryers or vacuum cleaners for them, they require that factory to meet the ethical standards for taking care of their workers. So this is the second demand driver. And demand for worker accommodation remains very strong in Singapore and Malaysia, where the number of foreign workers versus the available beds is either very finely balanced in Singapore or in Malaysia, shortage of available beds. So this is what drives the market for worker accommodation. In Singapore, we have currently 10 assets. 5 of them are owned by Carry and 5 of them are owned by Centurion Corporation. You see the boxes with the gold bar on top, those are owned by Carry. And the ones on the left, the 4 quick build dorms and Esprit Westlite Papan, continues to be owned by Centurion. In Singapore, the worker accommodation and demand and supply is finely balanced. In essence, the Singapore government requires employers to show that they already have an approved dormitory bed before they can bring the worker into Singapore. And 460,000 workers in construction, marine, shipyard, and process industries, by law, must stay only in approved dormitories. So that is the captive demand. Additionally, other workers in service sector, manufacturing, the bus drivers, the MRT drivers, can stay in public housing like HDB or the private older condos, but the employer can also choose to put them in the approved worker dormitories. So it becomes additional demand, especially when HDB rentals are very high, employers can choose to put them in the dormitories as well. Against that, supply is just finely balanced, 469,000 beds versus 460,000 captive demand plus additional 381,000 non-captive demand. And if you see on the left of the bottom of the slide, the best-in-class dormitories in the market are what we call purpose-built dorms. either those that are long lease, 20, 30-year lease or longer, or those that are short-term lease, 8 years or 9 years, and then the quick build dorms that was built by the government during the COVID to expand the supply. Additionally, because the good quality dorms not enough, the government allows factories to convert 49% of their gross floor area, GFA, into worker dorms. Then also on construction sites and next to construction sites, the government allows what we call construction temporary quarters, CTQ, or TOLQ, temporary occupation license quarters. Now, these are lower quality alternatives for worker housing. And if ever there is oversupply, the government will first remove these temporary lower quality housing. And so the ones that are more stable, resilient, likely to continue to operate will be the good quality purpose-built dorms. So with that, demand supply very finely balanced, very steady, and construction demand very, very strong for this 2025 and going into 2026 until 2030. Demand for migrant worker housing remains very strong. So against that backdrop, our occupancy for worker housing in Singapore, the portfolio was 99% occupancy for the year, and revenue grew 21% for Singapore portfolio. We have coming up between 2027 to 2030 a requirement from the government to reconfigure, retrofit our dorms to meet new standards that the government has set. The good news is that for Centurion's portfolio, we already meet most of the specifications required in the new standards, such as having toilet showers and within the apartment unit instead of communal shared toilet and showers. So in that area, we are already meeting the standards. Okay, and also the newer dorms we have completed, our quick build dorms, Westlite Ubi, the new blocks at Westlite Tokuan and Westlite Mandai already comply with the highest standard the government has set, which existing dorms only need to meet by 2040. So in the market, we have both existing dorms that need to be retrofitted and marginal retrofitting for Centurion, as well as the highest quality dorm. So we're able to offer the range of quality products to employers. So we are actively working to enlarge our portfolio in Singapore, given the strong market dynamics. We have received provisional permission to develop a new block at Westlite Ubi, which expected completion by end of 2027 will add approximately 540 beds. We also continue to grow the managed assets. We have in February this year signed a second contract to manage a third-party owned dorm, 1,500 beds in the Gul Drive area of Singapore. We have also in February announced the acquisition of a 65% stake in a company that owns a plot of land in the Ubi area, and we intend to secure approvals from the government to develop and operate a PBWA on that land. Okay, in Malaysia, we have 13 operating assets, including 8 that we originally owned, and then 6 that we acquired with a company called Harun Mega. And after the acquisition, 2 of the dormitories, we consolidated them into one property for operational efficiency. So today we operate 13 assets in Malaysia, combined a total of 36,000 beds. The majority of them are in Johor. We have one in Selangor and one in Penang. Worth a note, 2 of the Malaysian portfolio assets have actually been bought from us by the Malaysian Government Employee Pension Fund, Corp. They bought the assets from us because these are strong quality assets, and then they leased these 2 assets back to us to operate for a period of 15 years. So the Penang property, Bukit Minyak, and one property in Johor are now owned by the Malaysian Government Employee Fund, which is similar to Singapore CPF, but we master lease and operate them and retain the revenue from these assets. Malaysia is facing a bit of short-term headwinds. The government in Malaysia has implemented a quota restriction on number of migrant workers in Malaysia. They intend to bring the total foreign workforce to 10% of total country workforce by 2030 and then further to 5% by 2035. And so they have stopped allowing employers to bring workers into Malaysia. But the employers need workers, and they have lobbied the government, and the government has begun to relax this quota restriction. They have allowed employers, especially in construction and manufacturing, to apply to bring in workers. They've also allowed employers to pay higher levies to have more workers. So we see this limitation, this quota, beginning to ease, and we expect that demand will return in the near future. At the same time, the government is also promoting the new standards of worker dorms and enforcing to employers that they must put their workers in good quality dorms. So in the long term, we believe that Malaysia will have stronger demand for good quality worker dorms. In Malaysia, despite lower occupancy from the quota restrictions, revenue increased 8% for the year to 20.8 Singapore million dollars, right? So the decline in financial occupancy was offset by positive rental revisions as well as contributions from the assets we have acquired in September last year. So we remain quite optimistic on the Malaysia market, and we aim to enlarge our portfolio over the next few years through enhancing the assets we have acquired, as well as looking at new opportunities in other states such as Negeri Sembilan or Kedah. Our worker dorm business is very stable because we don't rely only on one sector. Construction accounts for 56% of our total employer customer base, but manufacturing, oil and gas, marine also contribute more than 1/4 or close to 30% of our revenue. So we are able to diversify our customer base across segments, and as certain sectors may fluctuate year on year, we're still quite stable. The other thing to note is no single employer accounts for more than 5% of our portfolio revenue. So no concentration risk in any single customer. Hong Kong is a new market, fairly new, and occupancy is at 62% for fourth quarter. We are monitoring and looking at how we can optimize performance before we consider further expansion in Hong Kong for worker dorms. Moving on to student dorms. Student dorm business is very stable with strong international and domestic student demand. And in fact, the shortage of student dorm beds, purpose-built student accommodation beds, continues to exist in Australia, UK, and other markets. So in UK, we operate 10 assets, 2,782 beds. 8 of them are held by Kerry, 2 of them by Centurion. All of our properties are in major cities that have strong universities, 2 universities in every city, and many of these universities are highly ranked Russell Group universities. Financial occupancy for the UK portfolio was 98% for the full year of 2025. Demand and supply imbalance continues, shortage of PBSA beds. Revenue grew 6%, even though occupancy remained stable at 97, 98%. So there was good rental revision still. So we are optimistic for student accommodation in UK. We do see some pressures in terms of visa control measures from the government, but we believe that domestic demand and international student demand will continue to be strong. We see a return in the number of visas issued beginning to rebound. And there is projection that the international student enrollments will grow. However, rental rate reversions have been very strong in the last 2 years. Moving forward, we expect rental rate growth to be more moderate, a flatter rental rate growth. So we have looked at opportunities to grow the UK portfolio. We have acquired a plot of land in London, William Road, Euston. It's a Zone 1 district in London. We are developing a 225-bed PBSA, expected to complete by the end of 2028. Australia, we had 2 assets as of 31st December 2025. One in Adelaide, 300 beds, one in Melbourne, 597 beds. And then in January, we completed and began to operate a 3rd asset in Sydney. And this asset is a more premium PBSA. We branded it Episode Macquarie Park, Sydney. And as of today, we are ramping up occupancy healthily in the 1st semester and expect that to come to more steady, stable state by 2nd semester. Occupancy in Australia declined a few percentage points from 96% in 2024 to 93% in 2025. This was mainly due to students arriving later in the year. Historically, most students arrive for the first semester by February or even late January. But in 2025, due to visa control measures by the Australian government, students began to arrive only in late February, early March. So 1 month of weaker occupancy. And then in semester two, which is July, August, also students began to arrive a little bit later. So that resulted in slightly reduced occupancy for the year averaged out. But we continue to be strong, positive for Australia student accommodation market. The supply of PBSA beds is still lower than total demand. There are estimated 8.5 total students for every available PBSA bed, and international student demand continues to be strong. So revenue declined 7% correspondingly to 15.7 million. And this was mainly due to the lower financial occupancy, but also due to some currency reduction for Australia dollar. We have therefore focused on growing Australia portfolio during this time. And between 2026 to 2028, we have assets that will be completing and adding to our capacity. So as I mentioned, episode Macquarie Park Sydney was completed in January. We have a development in progress in Melbourne, converting the car park of our existing property there into a new block 644 beds. Then in Perth, we also have a development in progress with expected completion by fourth quarter 2027. US, as I mentioned, we've sold the 2 assets and we are exiting the US market for now. We do not have plans to enter the US market again in the short-term future. Hong Kong, the 2 assets, just a little over 100 beds, are currently operating at 98% occupancy since the beginning of the academic year in September 2025. And we are monitoring the market for continued performance before looking at going further. Okay, so for Xiamen, it is opportunistic. We currently have 400 apartment units on BTR, leasing to young professionals in that city. Average occupancy grew to 90%, but we are monitoring further before we will commit to further expansion in that city. Okay, I'm sorry, gentlemen, I'm taking a bit longer on the presentation, so I'll try and skip through the ESG portions very quickly. We have a very structured governance for ESG that is important to us in terms of sustainability. And so from the board of directors to the senior management to the operating management, there are people put in charge responsible for ESG growth and focus for the group. We have committed to the World Green Building Council to aim at reduction of our carbon emissions between 2030 and 2050 with progressive targets. In Singapore and also in the UK, we have looked at our assets to be certified to be environmentally friendly, low carbon emission. So we have received both Singapore Green Building Council certification under the Building Construction Authority of Singapore, as well as international certification for some of our assets. These are international certification issued by the World Bank Group. Then in the UK, our portfolio all meets local regulated ESG carbon emission standards. Our social responsibility is something that we care a lot about, taking care of our migrant workers. It's one of the differentiators that help us retain our employers and make our brands preferred by employers and students. So this is something we focus on a lot. So the number of activities that we organize for our residents, as well as the participation rate, is something that we track closely. In the area of governance, we are also placing very high importance on that. We have been recognized by the Securities Investor Association of Singapore for our transparency, as well as for our corporate governance. We are also recognized for not having any violations, 0 violations of Competition Act and Code of Conduct. Okay, zooming into the last part, this is perhaps the most important part for many of us. So after the REIT spin-off, where we now own less assets, how will we grow? we will grow through three pillars. As I mentioned, we have operating income, and we will grow our operating income from owned and operated assets by acquiring and developing new assets to enlarge our portfolio, create more revenue streams from new bed capacity. Okay. We also look at active management to maintain our operational efficiency and maintain our margins and asset performance. In the second area, fee income will grow as CAREIT's portfolio grows and their earnings grow. So we will continue to help CAREIT improve, enhance their property assets, including adding beds, for example, at Ubi. And the fee, we will receive fees from property management as well as from REIT management, right? And these fees will grow as CAREIT grows. The third area, investment income, will also grow as CAREIT begins to have more distributable income and higher DPU. Underlying that, each time we develop and acquire and stabilize an asset and offer it to the REIT, sell it to the REIT, we will also gain from the development gain. So in terms of growing our portfolio, enhancing our existing assets, enlarging our portfolio, and then growing and recycling our capital to make our capital be more efficient, work harder for us, we will grow in these three areas. So if you look at our pipeline, we have assets under development in Singapore, Malaysia, and Australia that will add to our bed capacity, as well as UK in the longer term by 2028. For CAREIT, we will also look at helping them to enhance their portfolio assets and expand their portfolio of assets to enlarge the revenues. So moving forward, we're optimistic. We will look at optimizing our operating performance while we monitor the macroeconomic headwinds, potential inflation and interest rate instability or volatility. We'll continue to enhance our portfolio, and we'll look at deploying the cash proceeds from the REIT spin-off for growing the portfolio at scale. With that, I come to the end of my presentation. Moving on to questions, please.
Thank you so much, David, for the really detailed presentation there. And personally, I've really enjoyed it and learned a lot about Centurion Corporation. Particularly, it's good to note that the company generates a huge percentage of revenue from Singapore, which is what retail investors here in Singapore prefer in recent years, considering the weaker currencies in many countries against the very strong Singapore dollar, as well as home buyers. So now with that, let us move into the Q&A session, where Chee Min will be providing his responses to the questions we have gathered from the various investment communities. So the first question here is on the financial occupancy of the company's properties in Malaysia, where it has recorded a year-on-year decline, both in the second half as well as for the full year ended 31st December 2025, mainly due to the introduction of worker quota caps by the Malaysian government. That said, could the management provide further insights into the strategies in place to address and mitigate the impact of these challenges on the company's future growth in the country?
Hi. Junyuan, thank you for the question. First of all, I must mention this because Malaysia, we have these assets since, or rather we are operating these assets since 2012, right, till now. That's a number of years already. In fact, for Malaysia, there are some policies changes from time to time, and therefore it does affect occupancy rates, okay? But that being said, we have stayed on course in terms of investing more and more Malaysia assets or increasing our portfolio size in Malaysia. What's the reason? Okay, we believe that this is actually a short-term headwind. The government has actually tried to tighten the number of foreign workers in Malaysia. I think that's a natural cause, just like Singapore. Singapore has been doing that as well, in such a way that they don't over-reliant on foreign workers. But that being said, you know that just like Singapore, Malaysia does rely on foreign workers for certain jobs. Not all, but there are certain jobs that's necessary that the foreign workers can do, but not, or rather it's not so, I would say, conducive for Malaysians to take on, right? Just like construction, some manufacturing as well, and also plantation. So there's certain things that they could do, but basically the demand is still very, I would say, very strong. So what the government, or rather the businesses or employers would do, is actually to go to the government and lobby with the government in terms of the need for foreign workers' labor. And we are seeing that happening now. And while this is stricter, but the companies has to go through a process whereby they need to go through interviews in order to get the quota. But we can see that there are bright spots in that sense, that the government are really increasing the quota for them to bring in workers to address the economic, I would say, conditions. Because in order to grow, they do need this foreign workforce, not only just for the business, but also Malaysia as a whole. So that's the demand side. We think that this is short term, but basically overall there is a strong demand for foreign workers in Malaysia. And on the supply side, I would say on the supply side is quite short as well for purpose-built worker accommodation. Of course, there are alternate housing there, but more importantly is that the government is enforcing Act 446. Currently, there's a shortage, and that's why we, as a first mover, or in fact, our plan is actually to go even bigger, to be able to tap on this initiative. The government is trying to raise the housing standards in Malaysia. That we are seeing that many years ago in Singapore. I believe that will come also in Malaysia. Therefore, not only we feel that the occupancy will recover progressively, we are remaining very focused in growing our Malaysia portfolio to capture this demand over time. Yeah.
Thank you so much for sharing your insights there. So moving on to the second question is, given the tightening of visa applications for student accommodation assets in countries like Australia, how does the management plan to navigate these challenges and ensure continued performance in these markets?
Actually, the tightening of visa measures in Australia, in UK similar, they have tightened the visa measures as well. And that is actually to control immigration population in those countries. And that is, to me, is natural as well. However, we do see that these measures are relaxing, just like Australia, after which they see that while student does not actually really contribute in terms of the immigration into, or rather increase in immigration numbers in Australia. But that being said, they are still having these strict measures of issuing visas into those countries. But these measures has already been in place for, I think, 2 years now, 2 to 3 years now, okay? But we don't see there's impact in our portfolio that we are managing in those countries. There are some impact, but it's not really that material. Why is that so? First of all, we look at the market, there's still a continuous shortage of supply of good PPSA beds, and I will qualify as purpose-built student accommodation beds, not any housing beds in the private sector. And because of the shortage, there is a good demand for this PPSA beds. And the reason is because PPSA beds are offered the students a different experience in studying in the varsity. They can make friends and also provide better security, and that would be lacking if they choose to stay in private accommodation. Second thing is that also our portfolio we are in the real estate business, so location is important. So we are in, our assets are all in either the city centers or actually very close to established universities such as the Russell Group University in UK. So that has actually bought very well in terms of mitigating this visas measures that actually would have impact on the number of international students coming into the country. But that being said, in UK, there's a balanced mix of domestic and international students, so we do not actually rely only on international students. Therefore, the impact on these visa measures are greatly mitigated. And also in Australia, I would say that apart from just now we mentioned, they basically have some delays on issuing visas that affect us, but that is not really that material. But similarly for Australia, because of shortage of PBSA rates, we believe that over the long run, this will weed it out, and also these two countries, whether it's the UK or Australia, will remain a very good location for international students to look for a place to study.
Thank you so much, Chee Min, once again for sharing your insights with us. So one last question. With tighter accommodation standards here in Singapore, how will the industry evolve and what opportunities does this create for Centurion Corporation?
Okay, I wouldn't be able to speak for the entire industry, but we do see that the tighter standards in Singapore, including, or we call it the temporary standards, and also the new dormitory standards, would actually have an impact on operators, or even as existing operators, whereby they already built the dormitory, and therefore now, because the government needed some retrospective adjustment, that we need to do alteration of those assets in order to comply with the new standards. Some of the operators would not have the ability to put in more capital in order to comply with these standards, and clearly some of the operators will exit from the market. But at the same time, the workers' accommodation market in Singapore, as you know, that is very, very strong. And these fundamentals these strong characteristics and fundamentals will continue to attract potentially new and better capitalized entrants. Even some of these existing players will exit. But I think that over time, the demand and supply will rebalance, right? In terms of the shortage due to the compliance of the new standards, and then new dormitories will come in. I believe the government will release more dormitory for operators to bid. And complying with these higher standards actually shifted towards even better quality and better purpose-built worker accommodation, which Centurion is well positioned in. So we believe that we will be able to capitalize on this new opportunities that will come along when the government releasing more land.
Yeah, I totally agree with you. And thank you so much once again for the really detailed explanation there. So that's all the questions we have. And with that, we have come to the end of the Q&A session, as well as the end of today's corporate highlight episode featuring Centurion Corporation Limited. I sincerely hope the insights shared in this session have given you a better understanding of the company. So for those of you who have any further questions, please feel free to reach out to Centurion Corporation's Investors Relations team. And a big thank you to you once again, Chee Min, as well as to you, David, for your time to join us and sharing valuable insights with the investing community, and to all our community members out there for the really excellent questions. And I really look forward to doing another session with you in the near future. Until then, thank you and goodbye for now.
Thank you.
Thank you.
Bye.
Thank you so much.
Thank you.
Okay, bye.